I'd like to thank everybody for joining us today. Today, I want to talk about how we can reward our key employees with the use of split dollar. And split dollars is a great way because it's a non-ERISA program, so we can be very selective on who we include into this program. When you look at split dollar, you really need to take a step back as an employer and say, what is the cost, the real cost if you lose a key employee? And so if you think about that, there's just the replacement cost. You've got to recruit and hire and onboard, and you've got lost productivity. And oftentimes you may have to increase the salary of that new person, especially if you have to replace them even faster. So that replacement cost can be an extremely big burden on the company. But if you think about all of the hidden costs, I think those might be just as important or more important because did that key employee walk away with a knowledge or key relationships and take that away from the business? And if you're losing your key people, the rest of your team's going to feel that, and it's going to upset the whole business. And finally, it's the competitive cost. Is a larger company going to outbid you for your key people and your key human capital? And your best people are always the ones that are most recruited. So ask the question, what have I put in place that makes it genuinely hard for my best person to leave? That key person, make it difficult for them to leave because of the benefits that you can provide. So if you look at your business and think about this, will split dollar work? Well, do you have key people? Are they compensated enough? And are they compensated in a way that is unique? And would adding a non-ERISA perk with select people and in a way that is flexible and discreet and completely customizable, would that benefit you and your business? So let's take a look and see how this all fits together. With a split dollar policy, we start with a life insurance policy. And these life insurance policies, number one, they're going to, have a death benefit, but we're going to design them to grow cash value. That cash value, if properly designed, is going to grow tax deferred, and eventually the employee is going to have tax free access to that money after the plan is ran its whole cycle. When we first set this up, that policy is going to be owned by the key employee. Since they own it, it allows them to really see this benefit, touch it, feel it, and know that it's real. And that policy, the premium is going to be paid by the company, but the payment of this is going to be a loan. Since the premiums are being loaned, in essence, from the company to a benefit for the employee, those loans are not treated as income. They're not W-2 income to the employee. So we're designing this plan to be very, very efficient, for the key employee from a tax perspective. Now, since it's a loan, we want to have a collateral assignment against that policy to secure the repayment. Think about this as the mortgage on your home. If you bought your home and borrowed the money from a lender to purchase your home, technically, yes, you own your home, but there's a lien on that keeps you from accessing or selling that home or accessing the value of that home without the permission from the lender. Same thing happens here. Now we have the company making the loan for those premiums until the company's repaid or the company agrees the key employee can't access that policy. Now, if the employee were to die at death, number one, the company's going to get repaid the loan plus the accrued interest. Now, we can design this interest to be accrued, or we can design that interest to be paid annually by the employee. But whatever the company is out, they get repaid first. Whatever's left is going to go to our key employee's family. So what's nice here and why I like these kinds of plans is now we've gone beyond just our employee and provided a benefit to the employee and the family to make sure they're protected in a premature death. So that's our goal, is to build this up in a way that goes beyond the key employee and provides a real benefit to them and their beneficiaries. Now, follow the money. When you follow the money first, the premium is going to be paid by the company to fund the policy on the employee's life. That's going to be treated as a loan. So that loan is going to be on the books of the company. And of course, it's going to have interest, and that interest has to be at least the applicable federal rate required by the IRS. Can be more, but can't be less. And that interest can either be paid annually or it can be accrued into the policy, however the company wants that designed. There's going to be a collateral assignment in there, and that is the lien against the policy to make sure the employee can't touch this policy until it's paid off, until it's either the loan's been paid or at death, and then it moves to the employee's beneficiaries. And finally, there's got to be that repayment. We've got to have an exit from this. There again, death is an exit, but we don't want that to be our only exit. At some point in time, we want the loan to be repaid by the employee, and all that can be covered. So when the plan runs its whole course, everything is paid off on the loan, the interest, and the benefit is now there for the employee to use however they want during life. And of course, at death still is there. What does this look like in reality, in real practice? So let's look at this. Company's going to fund $25,000 a year of annual premium, again, as a loan. They'll do that for 10 years. We set that period however it makes sense for the company and the employee. There again, it's got to be a good incentive for our client, for our key employee, to make sure they see it as a benefit. So if we did this over a 10-year period, there's a $250,000 balance there that needs to be repaid at some time. That 250,000 is going to be a loan on the books of the company. That balance is going to grow each year with the premium and interest. There again, at some point, there will be an exit, and then the company recovers everything that they put out. What the employee sees is a policy that's growing in cash value, that provides a real benefit to his family. And throughout this whole process, all of this is something that is a real benefit provided to the employee. So, how do we get out of this? What is the end of this? The loan has to be resolved at some point in time. So the employee can pay off the loan with outside money. The employee can reach into the policy values of the insurance policy and use that as a rollout to pay off the policy or pay off that debt. Death benefit, of course, we've talked about. The death benefit pays off the loan and interest to the company first, and then the remainder goes to the family. And the other one is the company can just forgive the debt. Now, if they forgive the debt, there will be that's a taxable event, but instead of the employee having to pay back the whole amount of the loan plus interest, they only have to pay tax on that amount. So it's a significantly lower amount, provides a much bigger benefit to the employee. However, you can't promise that's going to happen, but that is an option for the company down the road. So the best thing is to always make sure the employer and employee know what the end of this plan looks like, just like we would the beginning. What each side actually gets. So from the employer, they've got a selective benefit, treated as a loan. It's a non-ERISA plan, and they will see this growing on their balance sheet until it's paid off. But it's a great benefit from the employer side, because their balance sheet doesn't change if they want to maintain their balance sheet. From the employee, they see that they own a life insurance policy from the beginning. They do have this loan that they have to pay back. They've got an income tax-free death benefit to their family, and they get to know there's a promise for them as long as they stay. All of this has to be documented. And we want to make sure that we have all of the pieces put together, documented, so the company knows what happens, the employee knows what happens. There's no surprise. And finally, the approach that we look at, number one, identify the key people, model the design so everybody's aware of that it's been set up correctly and designed properly. And finally, implement it with documentation and make sure it's funded properly. So I appreciate everybody getting on. If you ever have questions, reach out. If not, we'll talk again next week. Thank you.